So there's a growing wealth gap in DeFi right now, and it's not between retail investors and whales, but rather the informed and the uninformed. So many DeFi investors are throwing their money at positions, and a couple months ago, those positions might have been performing good, and it looks like they're an expert, it looks like they're Einstein, but then their true colors are revealed the past couple months whenever the market starts to tank, and people start to realize that their strategy is not what they thought it was. So while most people are suffering from their portfolios slowly bleeding out over time and consistently losing capital, especially when you compare it to holding in the market, smart DeFi investors are implementing strategic frameworks to make sure that they either consistently outperform market or, of course, have no market exposure at all. Now, I'm going to tell you about the biggest mistakes that I personally see DeFi investors making right now after working one-on-one with over 200 plus DeFi investors and helping manage over $50 million in capital deployments. Now, what I'm not going to do today is tell you to just buy and hold or wait for the prices to go back up. Because, of course, with some assets, the prices might not go back up. I am going to help you determine if your strategy fits with your risk tolerance, and of course, if you are comfortable moving forward with your strategy or if you should be adjusting that strategy. So right now, you kind of have to pick your poison. Are you going to accumulate, be one of those people that speculates on future price gains, which, by the way, there is nothing wrong with. I personally do that with pretty large portion of my portfolio? Or are you going to be an investor that focuses on stability and ensures that they don't have market exposure? And that's going to come at the cost of not having any appreciation. Bitcoin goes back to 100 grand, you're not going to see that appreciation. If your altcoins that are down 80% end up going up 2, 3, 4x, you are not going to see that appreciation as a stability investor. And once again, there's absolutely nothing wrong with it, but you need to get 110% aligned with what type of investor you are. Are you an accumulator or are you a stable investor? And again, it's completely okay to have both of these in your portfolio. I personally have both of these in my portfolio, and I'm strategically pulling cash from the strategies that I have in TradFi that are doing 5 to 10% per year and parking it in DeFi to strategies that are doing 50% per year. Now, obviously, that is not without risk, but when you're doing 50% per year, it's very, very hard for your risk to reward ratio to not make sense, which in this case scenario, it does. Now, we're first going to start off with asset accumulating, but before we jump into that, I do want to mention that we just launched a free community. And once again, completely free. You join up, there's chats, there's forums, there's even group calls with myself every single Thursday where I'm doing Q&As. And I'm not going to be doing those for much longer. We're going to hand it off to somebody else on the team. But now is the time to join up in that community. Get access to me, ask your questions every Thursday, and we'll go through it. But as an asset accumulator, you can't be focusing on token price. You have to be focusing on actual assets accumulated. And that's why a lot of people's strategies are being revealed their true colors right now, simply because users are focusing on price. So they're constantly selling out of one to hop into another, to hop in another, to hop in another. Instead, if their strategy is to consistently generate dollars, right, they need to be a stability investor, right? So that way they don't have that downside exposure. As an asset accumulator, I could be down 20-30% and not give a care in the world, simply because I know that, hey, I started with maybe 1 ETH, now I have 1.1, and then I have 1.2, so on and so forth. Even if that comes at the cost of starting with, say, let's just say $3,000, and then all of a sudden 1.1 is 2.5, and then 1.2 is 2K, right? I know that I'm growing this ETH stash, so when 1 ETH is back at $3,000, guess what? That 1.2 ETH is now worth 3.6K. So again, now that we've seen market gains, we've seen markets go down as well, you need to really just align with what type of investor you are. Are you an accumulator or are you a stable investor? Pick one, choose one, or pick two, have portions of your portfolio allocated to both. But as an accumulator, you cannot be sad whenever your assets are down, right? You need to be strategic and you need to use that as opportunities to accumulate more assets. And as a stability investor, you cannot be sad when the markets go back up and you do not have that price exposure, right? You have to be happy whenever you accumulate more assets, and you have to be happy that your strategy is actually working. Because guess what? If it's mitigating the upside, and it's also mitigating the downside. So that's what you choose as a stability investor. Unfortunately, there's not going to be a situation where we can have no downside basically, but unlimited upside, and then also a ton of high yields of like 10% per month. Unfortunately, there is not an instance. I know we all wish we could have that. Now, finding strategies for asset accumulators, I highly recommend you use tools like cryptocorrelation.com. I'm going to link this one in my free community like I do with all my videos. I put the tools and resources I use just in a post in there. But I also highly recommend you use, my software, Metrics Finance, right? Because ultimately what that's going to allow you to do is that's going to allow you to essentially be able to view your performance, not just on a dollar in, dollar out basis, but versus hodling in the market. So this right here is one of the clients that I'm working with on a one-on-one basis. Now they are hedging out the exposure on this AI16Z to Sol sell position. But just for reference, we could see their exact amount of earnings, unclaimed versus claimed. We could see their APR. We could see their profit loss, dollar in, dollar out. We could see their profit loss compared to holding the market, which is the most important metric for an asset accumulator. It's not APR, it's not earnings, it's not profit loss, it's not ROI, it's not asset gain. Their most important metric is versus HODL. And if you want to dive deeper into that one, you can scroll down into this divergence loss table. You're going to see your versus HODL compared to holding your initial assets, compared to holding in a 50-50 ratio, compared to holding all of one asset, and compared to holding all of the other asset. In this instance, the play would have been just throw the money in SOL, right? Because they would have had $1,266 more than what they have right now. They would have had $29,820. Since they're in the pool, they have $27,500 plus the $1,000 in earnings. Again, this one is a stability strategy, but I'm just showing you for reference. Now, the best way that you can combat that divergence loss, I'm just going to answer it right here, right, is have correlated assets. Get rid of the crypto to stable liquidity pools. You don't need them, because what are those going to do? Those are going to sell on the way up and they're going to buy on the way down, basically, which is going to cause a ton of divergence loss. Crypto to stable strategies are only good if you are selling/buying. And if that's not your intention, if your intention is to earn yield or accumulate more assets, right, produce income, then of course you shouldn't be using those strategies. I only use those crypto to stable strategies not to produce yield, but to essentially earn fees instead of paying them whenever I want to buy at a specific price or I want a dollar cost average, right? It's not part of my kind of income generating strategy or anything like that. But correlated assets, on correlation on demand, we can just go here. Hey, I want to look for stuff that's correlated to ETH over the past 30 days. And then boom, we could see all of the stuff correlated to ETH. Like for example, Lido has a 98% correlation. Why? Well, Lido has something to do with staking Ethereum, where you can stake your Ethereum through their platform. So it makes a lot of sense that their token is correlated to Ethereum. As a stability investor, ideally you want to find high yield strategies that are also correlated. That way it makes your hedging easier. But also you need to make sure that you can hedge it on platforms like Hyperliquid, on Radium Perps, or even a centralized exchange, shall you want to do that, basically. So again, right now you are probably using the wrong metrics to measure success. So many investors like to flock towards APY, APR, yields, profit loss. But if that's not the right metric for your strategy, like we just discussed with accumulators versus stability investors, then you should not be measuring against that metric. Like as a stability investor, profit loss is my most important metric in my pools, right? Because I want to make sure that I'm not losing money, right? But at the same time, as an asset accumulator, I'm not focused on profit loss. I'm focused on profit loss compared to holding the market. Focused on how much yield comes in and how much of that yield do I keep after divergence loss. Those are two separate things that you have to kind of drill into your mind and have absolute clarity and laser vision on, basically. Now I'm going to give you what I personally think is the biggest mistake right here. And this actually does have two parts to it. The first one is, of course, you are too diversified, basically. You do not want to have more than 10 positions. Why? Because ultimately you're going to have 10 decent positions as opposed to 5 really, really, really good positions. Now, personally, if we were to rate positions on a scale of 1 to 10, and let's just say if we have 5 positions, all of those positions are like between the range of 9 to 10, basically. Right? Let's just say they're all 10s. 5 times 10 equals 50. Whereas let's just say you have 10 positions, maybe even more, but those are in the range of 3 to 5. Well, then ultimately that's going to be lower than 50. Same score, but guess what? You're putting in significantly more time, which is causing your management to not be nearly as well, basically. So you're probably diversifying incorrectly. Now, when I say 10 positions, I specifically mean liquidity positions, active strategies that you are adjusting, you're rebalancing, you're investing into for income base. I don't mean HODLs, because HODLs, you don't really have to do anything. Lending and borrowing, if you're lending out assets, you don't really have to do anything if they're assets that you have long-term faith in, basically. So that's completely fine. That's how we diversify. We diversify by having a lot in liquidity pools, but using liquidity pools to build strategic HODLs, basically. And we're fine having 20 to 30 HODLs if push comes to shove. But right now I have 4 liquidity positions. 4. That's it. I'm about 60,000, 70,000 across all those liquidity positions right now. And once again, strategically ramping that up during this window of opportunity that we have. And one thing that I like to say that a mentor actually taught me a little bit ago is having more positions and being too diversified is just multiplying your mistakes. You don't want to multiply your mistakes because that's a downward spiral into your portfolio, consistently bleeding out over time. And the second fundamental mistake that I think the majority of DeFi investors are making is not having a strategy in place to actually follow. And hey, at the end of the day, this right here is not your fault. And the reason why is because you're new to this industry, right? And there's no playbooks that you can just follow and instantly have success like you could do in the stock market now that it's been around for decades, basically. So this is a completely new industry, and there is very, very little actually good information out there. And even then, when there is information out there, you struggle to actually implement this information. You might see a ton of, features on Metrics Finance, but not know what to do with them. You might see a ton of information on my YouTube channel, another person's YouTube channel, on Twitter, but you have no idea on how to actually take action on that information. Or you might find that information and start to do the smart thing, feed it to AI language models like ChatGPT and have that parse that information. But even then, it struggles to actually come up with actual ideas on how you can put strategies together because it doesn't have real-time data like you need. So you're trying to do everything yourself, piecing together information from YouTube, Discord, Twitter /X, and every other social platform out there, but it's just simply not working. Where successful investors are following proven frameworks, whether it's from peers, whether it's from other companies, or whether it's from my company. And when I say a proven framework, I don't mean a proven framework that worked for myself. I don't mean a proven framework that worked for 3 people. I mean a proven framework that worked for 200 plus people and is based on actual contingency strategies when the market does bleed and when the market doesn't bleed, and also when the market goes sideways, right? It's based on data from institutions that we have consulted with. That right there is what a proven framework is. Having that at your fingertips is your edge to success in DeFi, truly. So again, the solution to actually succeeding in DeFi, it's not more information, it's not more YouTube videos, more ChatGPT research. It's simply the right information implemented correctly. And that's why we have 2 systems to follow, the DeFi formula framework and the DeFi stability system, one for asset accumulators and the other one for stability investors. And this approach is what has helped my clients generate consistent DeFi income even when the market is going down, because they are picking their poison. They are choosing an approach and they are sticking with it at the end of the day. So look, I've shown you what's possible today. I've identified what most people in DeFi do wrong. And if you're going to take something from this video, let it be try not to do everything at once. Try not to be over diversified. And of course, get the right information no matter where you get it from. But if you do have at least $25,000 in your DeFi portfolio and you're struggling to succeed on whatever metric you're benchmarking on, whether it's dollar in, dollar out, whether it's beating divergence loss, whether it's even APR, right? And you want an actual implementation team and somebody that's going to hold you accountable, that's what we do at Builder Wealth. We strongly believe in giving away 85% of what we know. And the reason why is because information at the end of the day, it's readily available, especially with AI and other agents. But implementation, being on the phone with one of my team members that I personally coached, being able to ask us questions whenever you have them, being able to hop on weekly group coaching calls to get recaps on the market, that is what we sell. So if you guys do want some support, I'll leave the link to our website below. There's a 90-second form that you can fill out. That would basically just make sure that you are qualified for our services. You'll hop on the phone with one of my team members. We'll make sure that we are a good fit for you because truly it is going to be a mutually beneficial partnership and we'll move forward from there. And if not, that's completely fine as well. Just remember the takeaways of this video are choose your strategy. Are you an accumulator or a stability investor? Are you too diversified? And do you actually have a strategy in place? Guys, I'm going to be making some more content regarding how you can actually be less diversified in a strategic manner, how you can put a strategy in place, and how you can choose what type of investor you are by finding accumulation strategies or finding stability strategies. So make sure to drop a like, subscribe, notifications turned on, and I will see you guys in the next video. Peace out.